Welcome to the Market Edge Tech Talk with Will Pauly and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tuesday Tech Talk for Tuesday, November 19th, 2019. My name is Will Pauly and I'm here with my co-host, David Blake. David, how are you doing today?
Good, Will, thanks.
All right, David, let's start off with a look at the market, what the market's been doing this past week with a look at the market letter. Can you give us a quick explanation of what we're seeing here?
Okay. All right, well, we had the major average hovering near record highs for most of last week. Investors pretty much were waiting on word that Phase 1 trade deal was ready to be signed. And we were kind of stuck in a pretty narrow trading range until word came out Thursday afternoon that China and the U.S. were ready to put the pen to the paper. And that rallied stocks on Friday, and several of the key major indexes were able to make new highs. That include the Dow, the S&P 500, and the NASDAQ. Kind of funny, we had strength in the defensive sectors, such as REITs and utilities. They outperformed. Healthcare was also strong. And then we had strength in, in technology based on earnings from NVIDIA and Applied Materials, which gave a nice boost to that, especially on Friday as that came out. The laggards last week were energy and financials backed off a little bit. Part of that was because rates backed up a little bit, came down from about 1.9 the week before, it came down to about 1.7 at one point. So that would weigh a little bit on the financials. But because of Friday's rally, we had a fifth consecutive week of gains in the Dow. A lot of that was helped by Walt Disney, which closed at a new 52-week high towards the end of the week. The S&P 500 extended its win streak to 6. And I think the NASDAQ was up for 7 weeks in a row now. And it also, like I say, climbed to a new all-time high on Friday. Now, what's interesting was the Dow Jones Transportation Index was the weakest performing index. It was down about 1.7, and the Russell also was down. The Russell just can't seem to get through that 1600, although today we actually got to 1602, and we'll talk about that in a little bit. But the technical condition of the market was slightly improved last week. Again, the technical indicators are still in bullish ground. Momentum has remained positive. The Dow Jones Transportation Index and Small Cap Russell 2000 Index, though, finished lower for the week. So that's a little bit of a concern. It's a little bit of a red flag that shows some negative divergence. Now, despite some consolidation in the transports, that index did hit a new 52-week high the previous week, which triggered a Dow theory buy signal. So we go to triggering a buy signal to some negative divergence in a period of 2 weeks. We're getting some conflicting signs here, which are make it a little bit tougher for investors. Also, I mentioned in Friday's letter that despite the Russell 2000 pulling back a little bit, as a chartist, I looked at the chart on there, and it looks like the Russell 2000 may have been forming a bullish flag pattern, which would indicate that we were getting ready to break out to the upside on that. If the index can trade above 1605 with some good momentum, that may signal that a bullish breakout for the whole broader market is going to happen, but it's starting to grow a little bit more suspect as we look at some of the negative divergences that are showing up in some of the different indicators that we follow. Okay, breadth is one of the places that we're looking at negative divergence. That's we saw the NYSE and NASDAQ advanced decline lines move lower for a second straight week. And we're also seeing a contraction in the number of new highs and an expansion in the number of new lows. In fact, this week, the NASDAQ new 52-week lows outdid the new highs on 3 of the 5 days that we were in last week. Finally, we're having some complacency in sentiment. We were at a -8 on the Market Edge Sentiment Indicator 2 weeks ago, which is I can't really remember it being that low. We did come up to a -5 last week, but what that's telling you is you're getting too complacent, and some of the traders are getting too bullish about that, which can always be a little bit of a problem for the market. Finally, one of the things that we look at, that we measure is how far the index, the Dow Jones is, or the S&P 500 is away from the 200-day moving average. Last week we were around 6.8, which is extremely high. That usually calls for an overbought condition. It usually gets a pullback. As of yesterday, that average, we're now at 7.2% above the 200-day moving average. The last time it got to that level was in July, mid-July, when we saw a pullback in the broader market, about 3 to 5%. So things are we're getting some conflicting signs. Like I say, although we're trading new highs, we're seeing a lot of negative divergence showing up, but there are some differences between when the market looked like this and we were getting negative divergences in September of 2018 and what we're seeing now.
All right, so you've talked a bit about negative divergence in the market recently, or at least here today. Can we talk about how this will impact our investments going forward?
Yeah, let's go to the pull up a market recap over here. Let's go on down here, and first let's go to the right here. Okay, now you're seeing the NYSE advanced decline line. As we look over here, we're still near new highs, which is good. But it's been about 2 or 3 weeks since we've made a new high in the advanced decline line. Today, the Dow was off a little bit, and we have another. It's going to pull back a little bit further. The AD line on the NASDAQ, like I just said, for the last couple of weeks, it's been drifting lower, which is negative divergence. What this means is, as the NASDAQ and NYSE are making new highs, you're having less and less stocks under accumulation, and you're having more stocks go down. That's what we mean when we talk about negative divergence. It's not supportive of the record highs. Okay, let's go down here now to the new highs and new lows. And you'll see that on the NYSE, we almost came up where we were about flat here at one point last week, and then we saw a little bit of a bounce off of that, where the new highs and new lows were about equal. But if you look over here on the NASDAQ, there were several times last week where we had more new lows than new 52-week highs. Again, that shows negative divergence, which means that the number of stocks that are pushing to all-time highs with the index is becoming fewer and fewer. That's not what you want to see. You'd like to see broad participation in new highs. And when you see these negative divergences like that, they're called non-confirming indicators, which means that even though we're making new highs on price, if you just read the paper and went, oh boy, we're making new highs again, I need to get in the market. It's breaking out here. I got to be in it. But if you look into the technical indicators of some of these things that we look at, you can see that this isn't a healthy market in this place. It's still a problem where you have a lot of the big cap tech stocks are leading the whole broader market, and then we're also being whipped around by the trade talks, which again with the Dow Jones, every time we get a talk about a trade deal being signed, you get a big surge in Boeing, Caterpillar, Dow, 3M, companies like that will swing the whole broader market. Okay, now I talked about sentiment. What I see in that as far as negative divergence, what you don't want to see is you don't want to have everybody being bullish on the market. If everybody's bullish, that means they're fully invested, and you don't have any money on the sidelines to come in. Although you'll hear the talking heads on TV say that there's a lot of money in the money markets, and that's probably true. However, as of last week, the percentage of bullish investment advisors was 57.6. Anything over 55% is basically a red flag, and the percentage of bearish investment advisors is only 17.9. Now, what that tells you, anything like that's, I think it's 25 or 30 is bearish for the market. There just aren't any bears out there at this point. And 17 point, you'd like to see that percentage of bearish investment advisors up around 25, 30, 35% if you're going to put some new money into the market. The Fear and Greed Index, which measures sentiment in investors, that's up around 87.6. Anything over, I believe, 75 or 80 is bearish for the market. So when you look at these sentiment indicators, you're looking for indicators to get to extreme levels. When they get to extreme levels, that almost always you're going to see a pullback in the market. So these are things that we look at as far as if the market's going to continue higher or not. Now, a couple of years ago, if you remember, when we went to a sell in the market in September, the end of September in 2018, and then of course the market went down about 20% from that. We're looking at a lot of the same things that we're looking at right now as far as the negative divergence. However, there is a big difference this time, and that is that in September of 2018, interest rates were they were starting to tick up, and so we had to look at this where if we were getting rising rates, that was going to be a negative for the broader market. In this situation, we've had 3 interest rate cuts that is going to probably support the downside. So while I'm talking about where you may want to come off margin, you may want to hedge yourself because of the lower rates and the fact that we probably have bottomed out in the earnings trial. I don't think we're going to see that big of a market pullback. And in fact, at this stage, what I'm looking at is probably about a 3.5%, maybe a 5% pullback between now and the next couple of weeks. Another thing that we look at, if you follow our cyclical trend index or CTI, it's slated to go negative this week on Friday, which generally means that the bullish cycle in the market is peaking right in here, and the market will be susceptible to more downside at this stage. So we've got a lot of things lining up that tell us that that we're extended, we're overbought, we've got negative divergences, and all these things, when you put them together, are probably going to limit upside. Now, your 2 big factors that could cancel all that out is a trade deal, and we'll probably talk about this next week. I may write about that this week in my Schwab Active Traders article, and that is I'm going to talk about a blow-off top, which is possible still in this market, where if we get a trade deal, you see the market go up 300 points in the morning, and then about noon we're only up about 200, and about 2:30 or 3 o'clock we're only up about 100 or 70 points, and the market's starting to go down. That would, and volumes picking up, that would be an indication that we're getting a sell the news type of thing, because a lot of the market's gains in here are dependent upon a trade deal being signed, and so when it finally happens, we may get the traders going, okay, it's done, we got it, okay, that's holding the market up. Now we're going to sell the news, and that could intensify more selling at that point. But the lower rates should keep us around a 3 to 5% pullback, and if that's the case, then we'll we'll go back into the seasonality trade, where in December you generally will start seeing more money flowing in the market. The other kicker I wanted to mention is when I talked about the Russell 2000 small cap index struggling here at 1600. That means that a pullback of that would be bearish for the market. Then again, if we see the small caps break through 1605, say 1610, 1612, and volume picks up, that would be another indication that we're going to have some rotation to smaller caps that would be good for the market. So again, conflicting signals all around, and I think it's a tough time here to figure out what's going to go on. But in my case, I think you just want to pull back a little bit on your aggressiveness at this stage, and just anticipate that we may get some selling.
All right, now we got a question this week about the Hindenburg Omen. Is there any light that you can shed on this subject, this indicator, for us?
I can. I wrote about for the Schwab Active Traders weekly newsletter this week. I wrote about the Hindenburg rises again, and what this is a pattern in the stock market where the index will break out to a new all-time high, and then you look at the internal breadth pattern, and again, it has to do with kind of the negative divergences that we're talking about. This week, the NASDAQ flashed a warning of what they call the Hindenburg Omen several times. It's usually associated with the NYSE, but It's a pattern that has preceded every stock market crash since 1985, and it did show up again last week. It's known as the Hindenburg Omen. Of course, it's named after the German Hindenburg Zeppelin, which crashed and burned back in 1937. But before you hit a panic button, the Wall Street Journal has done some work on this lately, and actually since 2010, it hasn't produced anything more than a 4.8% dip, and that was in August 2013. So even though it's fun to write about some of these things, it basically is a sign of it's a indicator that looks at negative divergence. What the Wikipedia talks about. Okay, the daily number of NYSE new 52-week highs and the daily number of 52-week lows are both greater than or equal to 2.8%. This is typically around 84 to 100 stocks as the sum of the NYSE issues, and that advanced decline that day would be lower. And the NYSE index is greater in value than it was 50 trading days ago. And then you look at the McClellan oscillator is negative on the day. And those that follow the S&P short-term oscillator that we put out weekly, you'll notice that you're wondering why the market's making new highs, yet the oscillator stays around 1.2, 1.1, 1.3. Why isn't it overbought? And that's because the new 52-week highs and lows and the advanced declines go into that calculation for the S&P oscillator. And because we're having contraction of the new highs and expansion of new lows, that's keeping the oscillator from becoming overbought. So the bears could be licking their chops when they see that kind of signal, but it's just it's kind of a forecasting thing that used to work great, but right now it's kind of iffy. I know Art Cashin, he's from the UBS Director of Floor Operations. He says that investors should be alert to it, but they shouldn't be panicked. It's a signal that says that we may have a serious sell-off, not that they must have a serious sell-off. And so, again, it's just something kind of fun to know about. And if you see some things like selling intensifying, it would be something that would be something to be aware of that in the back of your mind if you start to see some more selling. And what I'm watching personally, I want to see if the S&P 500 would break below 3085. That's going to be a red flag for me that selling could pick up a little bit. And if that does start to pick up there, we would break. I think our downside target, if we would break that, would be around 30.10, 30.15. So not a real serious pullback if it happens, but that would just kind of be aware that if we do have something like that, the low rates should be able to keep a floor into the market. And if anything, I think that you could probably have a list of stocks that you may want to buy on a pullback, and if we get down to that area, you can put some money back to work in the market.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like answered in the next Tuesday Tech Talk, email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.